For years, my relationship with cars has been purely emotional. I buy them for the noise, the feel, the escape. My pension, on the other hand, goes into boring stocks and shares, sensible, predictable, safe. But what if I've been doing it all wrong? What if the thing I love most could actually outperform the thing I rely on for my future? Today, I'm diving into a world I never really considered: cars as assets. Not just the million-pound hypercars you see at auctions, but the humble hatches, the forgotten coupes, the everyday machines that have quietly turned into gold. I'm going to find out which cars are the biggest winners and losers from an investment perspective. I'll compare their returns to my own pension and stock market gains. And along the way, I'll discover a way that anyone, not just the ultra-wealthy, can own a piece of automotive history for the price of a used family car. But first, a disclaimer. I'm not a financial advisor. This isn't investment advice. Your money is always at risk when you invest, whether it's in stocks or steel. Do your own research. Speak to a professional. This is an exploration, not a recommendation. I've come to meet a man who treats cars the way most people treat bonds. His name is David, and he runs a company that allows ordinary people to invest in classic and performance cars by buying shares. Think of it as crowdfunding, but for automotive assets. The first car he shows me is a lesson in scale. It's a battered little Citroën Saxo, the kind of car you'd expect to see abandoned in a field. He bought it for £500. 2.5 years later, he's been offered £2,000 for it. That's a 400% return. 400%. But here's the catch. 400% of £500 is only £1,500 profit. It's a great return, but it won't change your life. Then he points to a Ferrari 550. He bought it for around £90,000. Today, it's worth about £125,000. That's only a 25% return, but the 25% represents £35,000 in profit. The math is simple. Percentage returns are exciting, but absolute returns pay the bills. The problem is, most people can't afford to invest £90,000 in a single car. And that's where the concept gets interesting. David's platform lets you buy shares in the Ferrari for as little as £500. Suddenly, the barrier disappears. You're not buying the whole car, you're buying a piece of its potential. We start walking through the collection, and it's a time capsule of automotive ambition. First, a Peugeot 205 GTI. This is the car every enthusiast talks about, the poster child of the hot hatch era. A decade ago, you could pick one up for a few £100s. Now, pristine examples are fetching tens of thousands. David shows me a one-owner car with just 24,000 miles on the clock. It's completely unrested, a survivor. He values it in the mid-20s. Over 2 or 3 years, it's delivered an annualized return of around 10 to 12%. Solid, but not spectacular. Then, a car that hits me right in the nostalgia. A Ford Fiesta Z2i in the exact spec I owned after I wrote off my first car. The interior is pure 90s time warp. That weird velour, those seats. This one is special. It was originally fitted with Recaro seats by the dealer, and the original seats are still in storage, wrapped in plastic. David bought it for £12,000. Now, it's close to £25,000. A 100% return in just 2.5 years. That's the kind of growth that makes you question every sensible financial decision you've ever made. The cars we loved as teenagers are now worth more than our pensions. But not every hot hatch is a winner. A Mini Cooper S, the rarer John Cooper Works version with the supercharger, has only returned sub 10% annually. It's still a profit, but it's a reminder that even within the same category, performance varies wildly. So how do you pick the winners? David tells me they use an algorithm. It ranks cars by popularity, historical significance, and driving enjoyment. And it's thrown up some surprising names. He walks me to a Renault Clio V6. I've always loved these, even though they're famously terrifying to drive. The engine is in the back, the handling is wild, and the concept is insane. David bought one for the mid-20s and sold it just 10 months later for the mid-30s. That's a 38% annualized return. The investors held it for less than a year and walked away with a significant profit. Then there's the Renault Megane R26R. This is my personal favorite front-wheel drive car of all time. It's stripped out, has polycarbonate windows, a titanium exhaust, and a carbon fiber bonnet. Renault only built 230 of them. Years ago, I had the chance to buy one from Renault's press fleet for £17,000. I bottled it. Today, David says a decent example is worth between £35,000 and £60,000. That's a return I don't even want to calculate. But timing is everything. David shows me a Ford Escort Cosworth, the iconic rally car of the 90s. He bought it 2 years ago for around £60,000. Today, it's worth maybe £70,000. A 5 to 6% annualized return. Respectable, but not exciting. If he'd bought it 3 or 4 years ago, he could have picked it up for £35,000 and nearly doubled his money. Hindsight, as they say, is a wonderful thing. And then there's the hidden danger. David explains that they use AI to scan social media, forums, and salvage auctions for images of damaged cars. They recently discovered that a Ferrari F40, a multi-million-pound supercar, had been in a nasty crash years ago. The current owner had no idea. The car was fully repaired, but the history was buried. Imagine owning a piece of automotive royalty and finding out it once looked like a pile of scrap. It's a sobering reminder that with classic cars, the past is never really past. But it's not all about hidden crashes. Maintenance is crucial. Every car in David's collection, 127 of them, is driven every 6 weeks. Not thrashed, but warmed up, checked for binding brakes, steering bias, and general health. It's a full-time job, but it's also a service. Investors pay a management fee, usually around 1.5 to 2% of the car's value per year. On a £5,000 investment in an M3, that's £100 annually. Less than a service. And unlike a managed fund, where you're just watching numbers on a screen, here you can actually come and see your asset, maybe even drive it. Speaking of the M3, I get to drive it. The E46, manual, 40,000 miles. It's lovely. But David's algorithm has identified a trend: big engines, manual gearboxes. And that brings us to a Ferrari 430. This car is a manual. When it was new, 90% of buyers chose the F1 automated manual. The manuals were ignored. Only about 100 right-hand drive manual coupes exist in the UK. 5 years ago, they were worth £90,000 to £110,000. Now, this one is valued around £135,000. David thinks they'll hit 10 to 15% annual growth, eventually reaching £200,000. It's the last manual V8 Ferrari ever. Once they're gone, they're gone. Then there's the Audi R8. Manual, V10. I love this car. The gearshift is a joy. But it hasn't performed like the Ferrari. It's only up 5 to 7%. David thinks that's about to change. There aren't many V10 manuals out there, and at some point, the appreciation has to hit. It's a waiting game. We move up the ladder. A Mercedes SLS, with its gull-wing doors. I've always loved the look of this car. David bought it because it was cheaper in red. Most buyers want silver or black, but he still expects it to grow. Then, the car that really catches my eye. A Porsche 996 3RS. The original. Only 682 ever made. When new, Porsche couldn't sell them in the US because of the roll cage. But as they approach 25 years old, they become eligible for import, and American collectors are desperate for them. 5 years ago, they were £100,000. Now, This one is worth around £180,000. David thinks they'll hit £280,000 to £300,000. Sometimes, the best investment is the one you can't legally own until it's old enough to drink. But not every high-end car soars. A McLaren 4-12 degrees centigrade, the first car McLaren built on its own, hasn't moved much. David bought it for £80,000. It's now worth £85,000. No loss, but no exciting gain either. And it has a design flaw. There's no door handle. You have to slide a touchpad. In the wet, it doesn't work. We struggle to open it. It's a reminder that even great cars can have quirks that hold them back. So, after all this, I need to know, how does my pension compare? I checked my app. My annualized return is 9.6%. The S&P 500, where I also invest, has returned 14.7%. The FTSE 100, 11.7%. David's overall collection has returned 12.7%. So, the cars beat my pension and the FTSE, but slightly lag the S&P. But here's the kicker, cars are exempt from capital gains tax. On stocks, you can pay up to 24% of your profit. On cars, you pay nothing. When you factor that in, the returns are roughly comparable. But past performance is no guarantee of future success. If I were to invest in one car from this collection, which would it be? The SLS is tempting, but I keep coming back to the 996 3RS. It's raw, rare, and has a clear path to growth. David tells me they're about to launch a syndicate for a Ferrari 360 challenge car, with minimum investments of £5,000 or £10,000. And then, there's the big one, an F40 syndicate. A £2.5 million car, split into 25 shares at £100,000 each. That's beyond my budget, but it's fascinating to see how the market works at the very top. To get a different perspective, I visit another expert, Claus, in Denmark. His company manages even larger collections, including cars like the Lamborghini Reventon, the Bugatti EB 110, and a Formula One Ferrari from 1983. He explains that cars add spread to a portfolio. They're less risky than startups or tech stocks because the physical asset will always be there. And he confirms that Ferrari is the strongest brand, the Apple of the automotive world. But not everyone can afford a Reventon. So I asked Claus for a cheaper classic I could buy outright, drive regularly, and hopefully not lose money on. He suggests a Fiat Coupe, or a Lancia Delta Integrale. But then he shows me his own car, a Toyota Matum 1. He bought it 2 months ago for fun. It's analog, simple, with 120 horsepower and no rust, a rare thing for these cars. He plans to sell it before winter, expecting maybe €14,000 for it. In 5 years, he thinks it could be worth €20,000. It's the poor man's Ferrari, and it might just be the perfect entry point. So, what's the verdict? Cars can be investments. They can beat pensions and match the market. But they're not passive. They need storage, maintenance, insurance. They need to be driven. And they carry the risk of hidden damage, of market shifts, of changing tastes. The real question isn't whether cars are good investments. It's whether the joy of owning them, the noise, the feel, the escape, is worth the uncertainty. For me, the answer is increasingly clear. The cars we loved when we were young aren't just nostalgia. They're assets. And maybe, just maybe, the most sensible investment is the one that makes you smile every time you start the engine. If this exploration of passion, profit, and the hidden value of the things we love resonated with you, please support the channel. A like on this video helps immensely, and subscribing to Winds of Thought guides you to more deep dives into the ideas that shape our world. Would you rather have a boring pension that grows quietly, or a garage full of noise that might just grow faster? The answer says more about you than you might think.